Well, I need hardly tell you about the issues of low interest rates. You've been living with them, but so is the rest of the world for quite a while. And the reaction is that people who were, and many people here in Japan, who don't like to take risk, were saving, and they were getting a rate of return on their interest, and it basically disappeared or became very small. Now, as I said in my opening remarks, there is no magic. And markets are going to do what markets do. They're like the weather. We can't will them to be different. We can't control them, really. We just have to live with them, just the way we do with the weather or the other things in nature. So I have no way to make interest rates go up. And even central banks who try sometimes actually have relatively modest control to do so. So let's not talk about, gee, wouldn't it be nice if we only earned 5% or 7%, or sometimes, remember, back in the 70s, 21%, okay? Those are not choices. So what do we do? Well, a rational reaction from anyone who was satisfied where they were, taking basically no risk with the rates that they were earning. So let's say they were okay. When those rates disappear, not just temporarily, but for an indefinite period, then you're forced to make some choices. You can't just sit and wish that rates were going to go back up or be higher. You have to decide if you want to try to get to the goals for which you were saving and you were in equilibrium, which you can no longer get to with the lower rates, then your only choice, if you want to try to get there, is to start to take some risk. There is a risk-free instrument here in Japan, you know, JGBs or treasuries. If that, whatever that interest rate is, oh, okay. That's not for me. All right. I thought there was some. Okay, whatever that rate is, that's the risk-free rate. And nobody can give you a higher risk-free rate of the exact same kind, yen, etc. And it's a pretty strong statement. But suppose someone could, then why would anyone buy JGBs? The most sophisticated money investors buy JGBs. They're not college professors or taxi drivers or ribbon clerks. They're sophisticated investors. So if there was some real way to earn a higher risk-free return than JGBs, why would anyone buy them, and certainly buy them in quantities? That's a question for you to think about. So there is no way to create a risk-free, higher return than the markets. I may not like to hear that, but that's the starting point. So now let's talk about, if you want to still try to go for the goals that you had before, you now have to think about taking risk. And what I was just going to talk to you tonight is broadly a couple of areas, big areas, scalable areas, of which one could do to start taking some risk to replace, at least get an expected return that gives you a chance to get to that goal that you could have achieved before with a higher rate. Okay? Now, there are two categories of highly scalable investments. There's many investments, but large scalable investments. Fixed income and equities is what I'm going to talk about. Now, fixed income just means that the instrument has a promised set of payments specified. Equities don't have a promised set of payments. They're not specified. Within fixed income, you have notion of risk-free fixed income, risk-free asset. I will use the definition, not very imaginative. Risk-free asset is one who all its promised payments will be made for sure. Okay? Now, for you or for me or for a portfolio manager, the fact that some asset is a risk-free asset, as I defined it, doesn't mean it's risk-free for them or for me or for you. Why? Well, let's just take a simple case. Suppose you have a portfolio that the purpose you're managing it is to pay your taxes here in Japan in 6 months. For that purpose, the risk-free asset for your portfolio is a 6-month treasury bill, because that will pay for sure the amount that you need on the date that you need it. What about a 30-year or a 40-year JGB bond? Those payments will be made too. They're risk-free, but that would be a very risky thing to buy if your objective is to make a payment in 6 months on your taxes. You know this, I'm just reminding you of this. So you can have risk-free assets that are risky to a particular portfolio or individual. On the other hand, some older person who wants a stream of income in retirement that's secure, a 6-month treasury bill is one of the most risky things you could hold, because rates can go down. In my country, they went down from 4 or 5% to 10 basis points, 1/10 of 1%. $40,000 or $50,000 in income per million became $1,000. And even today, it's better, but not much. That was a 90-something% decline in income. That's very risky for a retiree. So those are the rules what I'm talking about. There's the risk-free asset, is an asset that you know will pay for sure what it promises. But the risk-free asset for a particular portfolio objective is that risk-free asset that matches the goal of that portfolio. A 6-month payment for taxes, a stream of income for the next 25 years, okay? Now, how could we possibly take risk with risk-free assets? We could choose to invest in risk-free assets in the sense that you'll get what's promised, but ones that don't match the maturity or the payout pattern that is your portfolio. So you'll be taking a risk. So if you have a 6-month horizon and you buy a 30-year or 40-year ultra-long JGB, it's a risk-free asset, but it's risky. You see? So the first step would be to say, if I found relative to my goal that I could get a higher expected return from holding a risk-free asset that's not matched and therefore is risky, that would be one way to try to take risk so that you could get some higher expected return. That's kind of the first increment I could think of. All right? And so one thing you can do is accept a mismatch, but you're still getting assets that you know exactly what it'll pay, but you don't know what you'll get for it when you need it. Okay? So that's the first thing, and we're going to talk about how to do that. A second way within fixed income, a risk, is credit risk. The fixed income instrument promises to pay you, but it might not. And you're not sure what it might not pay. So the promised payment is fixed, but it may not pay what's promised. And again, if that has a higher expected return than your risk-free portfolio asset, then it may make sense to take some of that risk, still retaining that it's a fixed income. So I'm just building this up. You want me to stop there?
Yes, please. 今8ページと9ページのところで新たなテーマのところに入ってきております。低金利の中でどういうふうにリターンを狙っていくかというような話に入ってくるわけなんですけれども、基本的には先ほどから何度か先生おっしゃってますけれども、何か魔法があるわけではないと、ノーマジックというふうにおっしゃってました。金利というかマーケットというのは基本的には例えば先生の例えで言いますと天気であるとか今もうちょっと自然みたいな部分であってそれをコントロールすることはできないんだということにご指摘の上でですね、ではいわゆる最初に債券と株を考えていくんですけど、債券の場合に低金利の場合どうやってリターンを追求していくことができるのかと。で最初にお話になってたのは、ある人にとってリスクがない安全資産であると、リスクフリーであるということは別の人にとってリスクフリーであることを意味するかというと必ずしもそうではない。例えば、何かの支払いの決まった支払いをしなければいけないであるとか、税金であるとそういった理由で、負債みたいなものを抱えている、支払わなきゃいけないものを持っているとか、若い人という年を取った人だという年齢による違いとか、そういったものによってある人にとってのリスクフリーというのは別の人にとって少し違う。逆に言えば債券というのは支払いが決まっているという意味ではリスクフリーなんですけれども、大きな金利変動リスクがある中で、自分のゴール目標があってそこにある種ぴったりマッチしているというのが、ある種リスクフリーの状況であるんだけれども、そこから、そのゴールから少し離れてしまうという部分のリスクを取るということを、許容するというんですか、そういうようなリスクの取り方があると。言ってみればリスクフリーのアセットを使ってリスクを取りに行くというのが一つの考え方だというのがご指摘で、もう一つ債券のゾーンのところでいうと、いわゆる社債のようにクレジットリスクを取る、信用リスクを取るということによってリターンを高めていくという2つの方法があるというのがここまでのお話です。
Okay. Now, I'm not going to go through each step of these, but I want to show you some possibilities broadly. I'm not showing you any particular strategy of how you might be able to find expected returns higher than the risk-free rate. And I'm going to use the risk-free rate to be like a deposit or something short-term. You could do it with respect to long-term if I'm a retiree, but just short-term, that's the usual way we measure these. And we're going to look at if we take a different maturity, a different pattern of payments, but it's risk-free, what might we get? Now, when we look at bonds, fixed income, unlike equities, we can see the market yields from the prices. So we can see the actual yields, spreads, if you like, as a function of maturity. The question is, do those differences in yields, differences in spreads, translate into differences in expected returns? The answer seems to be yes. So yield spreads, wide, do seem to be associated with higher expected returns. That's not automatic. That's not a tautology, but that seems to be the data. And so that means if you have, let's say, a rising yield curve, depending how much that spread is, how much steep it is, in general, taking the longer maturity, when you have a right spread, gives you a likelihood for expected return that's higher than the short-term risk-free asset, okay? And I've just drawn some pictures. Now, sometimes, as you know, the yield curve is inverted and actually goes down. You get a lower yield for a longer-term bond, in which case that's like a negative spread or a flat spread. In those environments, it appears that you don't get a risk premium, or very much one. So what do we see? I'm just throwing some numbers. I'm not going to do this. What we have here is a plot of spreads. I use the U.S. markets, but you could do the same thing, of spreads over time, going back to the 1970s, about 40 years. And you can see at times the spreads are very low, even negative, and sometimes they're high. What you can see here, I'm not going through the numbers, you have them, that when spreads are large enough, you get a higher average or expected return, and it's statistically significant. That doesn't mean it's true. It just means with a pretty high degree of confidence, the expected returns are higher. So what this shows you is by varying term, you can have the possibility of increasing expected returns, but recognize you're now taking risk. And that you have to consider. So I'm not going to go through each of these numbers. Now, if that is true meaning you're willing to accept it as the way you think, then what you want to do is look for as many opportunities as you can find where you get nice spreads. Sometimes they're negative, sometimes they're not at all. Well, one place to do that is not just to confine yourself to one country, US, Japan, but to look around the world at the spreads, at the term structure in every of these countries, or countries where you're willing to accept that the government bonds are risk-free in what they promise, okay? And this is just showing you for Australia, Canada, France, and so forth, the incremental returns you can get, or on average, at least historically, relative to the spreads. And you see the pattern is that when spreads are large in each of these countries, you get a statistically significant outcome. So as a strategy to try to get for whoever you're helping higher expected returns, by looking in all these different countries, you get more opportunities because the term structure is not the same in every country. So that's more places to look. If you just confine yourself to one country, you've got one term structure. You've got to live with that one. So that's what this slide is designed to tell you.
10ページのところからその先ほどの債券の戦略の例えば例ということで、基本的に債券ですからクーポンと元本のところの支払いは決まっているわけなんですが、10ページのところでいわゆる利回り債券の利回り曲線ですね、横軸に満期までの時間を取って縦軸に債券長期債とか短期債の利回りを、書いてありますが、その債券の利回り曲線が右上がりになったり右下がりになったりいろんな形状をしてくるわけなんですが、実証研究の結果として一つ知られているのは、長短金利差が広がってくるとその後の、債券の方の長期債の方のリターンが高くなってくるというような、ことが指摘されていて、それがタームプレミアム、期間プレミアムということで11ページのグラフのところに書いてあります。利回り曲線の形状によってその後のリターンが少し簡単に言ってしまえば予測力があるということになります。そうすると戦略によってそのイールドの考え方としては金利の利回り曲線が高く右上がりになっているときに投資をして、満期の長い債券を持つことにして、右下がりになっているようなときには短めの債券を持つなんていうことが考えられるようになってくるわけです。でさらに12ページのところではアメリカだけじゃなくて各国のデータを見てみますと各国においても同じような傾向が見て取れると。したがってアメリカで例えば利回り曲線が右下がりになっているという場合にはアメリカでは短期債を持っていて逆に右上がりになっている国では長期債を保有するといったような考え方で、先ほどのような戦略と債券を使った戦略というのも考えることができるというお話でございます。
Okay, so the next slide is much the same story, except, of course, if you buy bonds in another country with another currency, you're taking currency risk. So what this slide is about, and another one that I'm going to show you, but just go through, is if you buy a bond in the wrong currency, you can take that risk, and there's a volatility to it, or you can hedge it back into yen, right? You do it and you hedge it. What you see here, I just point out, this statistics show that if you just hold 3 to 7 year yen things, you earn in this period about 30 basis points a month is a indicator in that thing. If you held world bonds, that's what WGBI means, all the bonds in that category. Unhedged, you'd earn 36. When you compound that, that's a bigger number, okay? If you hedge them, you earn 32. So that's 2 still, it's every month, remember. So it compounds. That's not small when you're dealing with interest rate spreads. The compound returns you see there. But notice the volatility of buying just straight Japanese bonds, JP bonds, is 92 basis points monthly. When you buy these bonds and hedge them back, you picked up expected return, but you also reduced the volatility from 92 basis points to 80, about 12%. So there are always, my message to you, starting with people who are used to holding risk-free things. You don't focus on return. You know you want to try to get them a higher expected return to give them a chance. But you want to be focused on risk. If you're going to take a risk, make sure that they take as least risk as they have to try to get their target return. Usually we talk about getting the most expected return for the same risk. I don't think that's the perspective for this exercise. You're asking people to change something that they have been doing, perhaps, who knows, for generations, to start to take risk. You, I believe, therefore need to be very sensitive and focused on attention to keeping the risk as small as possible while trying to go for the targeted return. It's just a framing of the essence, and that's how I'm presenting it to you here. So can we do it in the most efficient way? And that's what this is showing, that we can. The impact of hedging is in this slide. If you were buying stocks, if you hedge it, you can see from the picture, there's so much volatility in stocks. You don't notice it really. It's helpful, but it's not. But look at bonds. Bonds, here's stock returns. You see, I can't even show you on this slide, but the difference between hedged and unhedged, okay, is not that different. Now, look here, okay? Unhedged in bonds, right? Look what hedged is. So can you just see from the picture, the hedging brings the risk way down. Now you know that in theory. I'm saying it's just numbers, so you'll know where to think about. So this is an interesting way to get the risk down, but still to try to access the opportunity. And this same slide talks about everything from fully covered to partially covered. You can go through it. And surprise, surprise, if you take more risk with the currencies, you get higher average returns. So these are kind of controls that you can look at to make those. Now, credit, I'm not going to spend much time on, and these are not big credit risks. This is triple B. This is still investment grade. Okay? That's a different animal. Why? Because you can no longer say to people, these are the payments that are going to be made. These are the payments are promised, but they may not be made. That's more complex. It's more like a stock. But staying investment grade is not too much credit risk. It's credit risk, but it's not big credit risk like junk bonds or something. Okay, so I'm trying to look incrementally. And again, the evidence is that when you have credit spreads where you can see the difference between the yield on the bond that's risky based on its promise payment and the yield on the risk-free version of it, when those are wide, you tend to get higher expected returns. And when they're tight, they're not. And therefore, you would want to adjust and look for places to try to get incremental returns, taking the least risk. And these are various strategies depending on the time. If you have tight premiums, you can put credit premiums together and with term premiums and integrate. So you can both take credit risk in some amounts and you can take term risk. And which ones you do depend on the market conditions of yield spreads there. So this is it. And that's really pretty much all I want to say about fixed income. I know that may not sound very deep, but it's important. It's scalable. It's not some one-off kind of investment that you can do, which you can do. That's not going to solve the problem. But those are the regimes you move in. Now, if we move to the other category of equities, the statement that I will make, and I say this to every sovereign wealth fund, the most sophisticated money in the world, if you are not globally diversified, holding very widely diversified across the globe, then you have an opportunity to improve returns at low cost, and it is very scalable. So you know, if you're Norges Bank or something like that with $1 trillion, you can do that scale because the world is your base. It may not sound exciting, but I want to show you some numbers to show you, or some pictures actually, to show it. And so I want to just, this is going to be, I want to talk about AI and everything, and I'm watching the clock. So,
13ページぐらいのところからですけれども、この絵の話、簡単に手短にまとめさせていただきたいと思うんですけれども、13ページのところは外株投資をする、外債投資をする、外国の債券に投資する場合の為替のリスクの問題を扱っております。数字が少し出ておりますけれども、債券の場合は、為替のヘッジをかけてあげると大きくリスクが減るんだというのが、基本大きなところでして、14ページのところでグラフがありますが、下の方がですね、債券の方ですね、債券の方のヘッジをしてない場合、アンヘッジの場合、それからヘッジをしている場合、これヘッジドっていうふうになってますけど、これで大きくリスクが減少していると、ボラティリティが減っているというのが分かるかと思います。上の方は株でして、外国株式に投資した場合に、外国株式の為替をヘッジしたらどういうことが起きるかということなんです。株の場合は為替も変動しますけども、株も変動しますということで、リスク量の、リスクを、ボラティリティを減らすという意味でいうと、あまり株の方には効果は、ないことはないわけですけれども、債券に比べるとあんまりはっきりしてこないということになっております。で、15ページはそういった先ほどありましたような外株投資をどの程度ですね、国内の低金利の環境の、例えば日本の低金利の環境の中で、日本の JGB と外国債券を組み合わせることによって、リスクとリターンをどういうふうに組み合わせていくかというようなお話が出てあります。16ページのところに入りますと、債券のもう一つのリスクの取り方ということでご紹介があったクレジットのお話になっております。クレジットの方に関しても、いわゆるクレジットスプレッド、債券のですね、満期を揃えるような形で、国債と社債の利回りの差を取るような作業をするわけですが、そのクレジットスプレッドというのもかなり16ページのグラフにありますように大きく変動します。スプレッドが社債と国債の差が大きくなる場合もありますし、小さく縮んでくる時もあると。17ページのところで紹介しているんですが、先ほどのいわゆるタームですね、期間プレミアムと同じような意味で、クレジットに関してもクレジットスプレッドが広がったとき、小さくなったときで、かなりその後のリターンに実は差が出てくるということが知られております。基本的にはそのクレジットスプレッドが大きくなったときに、リスクに対するプレミアムが大きくなる、すなわちその後はリターンが高くなるということが指摘されていますので、それを合わせて18ページのところではクレジットおよび先ほどの債券の満期の組み合わせを考えることによって、横の方がタームですから期間ですね、期間が満期に対するそのタームがイールドカーブの形状がですね、右上がりになったりフラットになったり右下がりになったりと、そういう変化 で縦の方がクレジットスプレッドが広がったり、縮まったりと、それぞれに合わせて、長期債と短期債、それから社債と国債の組み合わせを変化させていくというようなことが考えうるんだというご指摘になっています。それからその後またちょっと駆け足になってましたけども、20ページ以降のところでは、もう一つのあり得るリターンの追求の仕方として、株式の話がありますが、この資料には時間なくて割愛することになりそうですけれども、基本的にはやっぱり国際分散投資、要するに日本株だけではなくてですね、世界の株式に投資するということをすることによって、基本的にはリスクを抑えながらリターンを高めるということを行う十分なチャンスがあるんだということがご指摘されています。
Okay, so now I want to explain this one picture. There's several of them for different countries, but if you understand the first picture, then you can understand all the others, because it's the same methodology. To show you how costly it is not to diversify, or how beneficial it is to globally diversify, this is what this picture is showing you. The period 1993, that's a lazy professor. It just happened to be the data that was available. Because don't take these numbers to trade on. They're using real-world numbers to illustrate the point. If we do a different period, we'll get different numbers, but the outcome will look the same. Do you understand? I'm just using data to show you this is the real world and give you a sense of size. Theoretically, the world portfolio is the best diversified portfolio you have. That's you hold everything. MSCI is not the best version of that, but it's recognized. I just used it. Okay? So this is not I'm not recommending MSCI. I'm just using it as an example. That's the return. This is risk. That's average return. It's in dollars, but it wouldn't make any difference because we're looking at risk premium. You get the same picture no matter what currency you're doing it. So this is what you got if you held 100% risk in the world portfolio. If you hold less than 100%, meaning you put 50% in the world portfolio and 50% in short-term JGBs, then you will get this, roughly halfway between all risk-free and risky. So it's like a menu of risk return, depending how much risk you want to take and how much return you're hoping to get. But you understand you can pick any point on that line as possible using that portfolio. This is what actually the same number is if you just invested in Japan in the same period. Okay? That's not very interesting because that's what happens after the fact. You invest before you know what's going to happen. So Japan may have had some bad luck, and Japan's not alone in that regard. Okay? So that doesn't prove anything. What I did do, and this is the part I want you to try to think, listen to me. I asked the question, given that the world did this, the world portfolio, if you knew nothing about what happened to Japan, what would you forecast Japan would have done? Do you understand the point? Given that the world, let's say, in the next 20 years is up, 6% a year, what would be your forecast of what Japan would be if it neither underperformed or overperformed? You understand the experiment? You want to explain that?
Yes, please. Yes.
Yes, because this is critical. And then the pictures will go.
Okay. 20ページのところ、グラフを使いながら株式投資のところをご説明していただきました。横軸にリスクを取って、縦軸の方にリターンを取ってというグラフでございますが、MSCI ワールドというところにあって、が一つのその外国株式に幅広く分散投資した場合のリスクとリターンの関係性。でそこに、左の縦軸のところから UST ビル3マンスっていうのがありますが、安全資産があるとして、それ株と債券の組み合わせを決めることによって、さまざまなリスクリターンが実現できますねと。 で、実はこの期間の1993年から2015年のデータを使っているわけですが、この期間の日本の株式市場はどういう状況だったかというと、非常に、かなり悪い状況で、MSCI ジャパンアクチュアルというふうに書いてあるのが、右の一番下の方にあるものですね。これが実際に実現してしまったデータになります。で、もう一つこれから、今お話になってたのが、その真ん中にある MSCI ジャパン Expected っていうのがありますが、これはある種の思考実験として、日本の株式と MSCI ワールド、世界の株式との相関関係をデータの上で測ってですね、そのモデルの中で、実際には日本のデータはこういう非常に悪いなんですか、実際に実現したリターンは低迷してしまったわけなんですが、MSCI ワールドとの相関関係を使ったデータということで処理した上での考え方、モデルの上での考え方としてみると、真ん中の期待リターンというのが得られたはずだと、モデルの予測するリターンというのが真ん中のところに出てきているというお話です。
Okay. So, this is what happened with world. This is what we expect Japan would have done if it was performed as expected. Not overperformed, not underperformed. This is what actually happened. Now you can see that if you look at those three menus, for the same risk 5%, this would turn out lower than you expected. That just means Japan, after the fact, underperformed expectation. In the jargon, had a negative alpha after the fact. Nobody could necessarily know beforehand, so it's not a... But even if it was performing as you expected it, for 5%, you would get this expected return, but if you had diversified, you get the higher one. I want to try the other way. If I need to get an expected return of 4%, remember, we're trying to get to somewhere we have to take risks to get. So say I need to try to get it 4% with a chance to win. Here's 4%. If I do it on the world portfolio, this is how much risk I would have to take. If I do it just in Japan, I got to take that much risk. So the way to see it in this context is, by not diversifying, you're imposing more risk on yourself or your clients or who you advise for the same expected return. How much more? In this particular case, about 50% more. Now, I'm not talking about this. That was, I'm talking about comparing if Japan had done as expected. Just investing in Japan, you subject yourself or your client or your advisees to 50% more risk. That means you've got to tell them they could have much more risk to try to get that 4%. That's the message for this. Now, let's look at China. This is 1993. China's big, so you think it's pretty diversified, right? It's a big country. And was this a growth period for China? You bet. How about if you just invested in China? Well, it turns out, like Japan, China underperformed expectations in the markets. It had great growth, but the stock market did not do well. Now, again, not saying that you could have known that. But again, this is the world. Here's just investing in China if it performed neither under or overperforming, the blue line. Do you see? Once again, 4%, this is how much risk. 4% just in China, you're out here. A lot more risk. In fact, 100%, twice as much risk. Remember, you're trying to move people who who are very risk averse to take some risk. So the message is there. Now let me just show you a few others. Here's Indonesia. What's different about Indonesia in the first two cases? That's how it did, and that's what we expected to do. Indonesia outperformed what we expected. It was a big winner. How big a winner? 4% alpha. Huge. So if I told you for your clients, you could have a 4% alpha for the next 22 years, you'd be celebrating. And you should if you use alpha right. But if you made the mistake of saying, Indonesia is going to outperform, so I'm going to just put my money in Indonesia, look what happened. Even though it outperformed by over 4%, let's look at what happened. That's the risk you take for the 6% return. That's the risk you would take. You got a lower return for risk reward in Indonesia, not by expectation, but by the realization. Even though you had outperforming, a superior performing country, I could have guaranteed that to you, and you probably would have all put your money in it because I guaranteed you a 4% alpha. You would have done only 3/4 of the reward to risk that you could get just with world diversification. And finally, I just show on this, I did for a longer period, 35 years, Australia, one of the best performing countries. And once again, same story, outperformed. This is what was expected. And even with the outperformance, it did worse than the diversified portfolio. The bottom line message to you, I only have so much time to bring this to you. If you're going to take risk to try to make up for it, in fixed income, we talked about what you can do and what rough numbers might be. There's no magic. They do have to take risk. In equities, I've shown you the possibilities, but what I'm showing you is if you're not diversified in the portfolio, I don't care, you got hedge funds, you can have the smartest, cleverest, all of that. You're not going to perform as well. You can get lucky. I could buy a lottery ticket, But this is uniformly consistent. So the message to you is you can use equities to improve it, and you can use fixed income or both. And it's a menu. But what I've tried to show you are things that are scalable, relatively easy to explain to people what they're doing, what risks they're taking, and so forth. Not some crazy investments with lots of costs and you can't explain it to anybody because it just doesn't work. So I've only got 10 minutes left and I really wanted to do it. So message on small interest rates, you got to take risk if you want to try to get to that goal. And full stop. If you're going to take risk in the fixed income space, you can do risk-free assets, but they're just mismatched. So they're risky for the client. You can take credit risk, which is, you don't know what the payments are going to be for sure. It's not risk-free. And that has certain characteristics. And if you mix the two, you can add return, meaning for a certain amount of risk, you can get return. In equities, you can get more, but you have more risk. But whatever risk you take should be the smallest risk you can figure out. And so if I were grading you, like on the CFA, on your certification, if you told me I bought Indonesia because I knew it was going to be a better performer and put my money in it, I'd give you a failing grade because that's not the way it works. So if I give nothing else, these are the tools you have to work with. They require expertise and understanding of an explanation to people, but they have to understand they're taking risks to get there. Either that or they just have to accept the lower lifestyle. I don't have any other thing to offer to you on that. Okay?
はい、21ページから23、4ページのあたり、23ページぐらいのところまでをごく簡単にちょっと復習しておきますけれども、基本的にはその日本であるとか、中国ですね、20ページ、21ページのグラフを見ていただいて、日本も中国も予想していたよりも悪いパフォーマンスだったということではありますが、予想通りであったとしても、実は中国一国、日本一国に投資するよりは、MSCI ワールド、世界に分散投資していった方が良かったと。 予想よりも良い結果が出たというのが22ページ、23ページ、インドネシアとオーストラリアなんですが、予想より良かったリターンが出ているにもかかわらず、やはり実は MSCI ワールド、世界に分散投資している方が、まだリスクリターンの対比の意味で良かったということが大きな株のところでのメッセージになるかと思います。